Will Adobe continue to disappoint expectations? Welcome to the Valuation Masterclass case study, where you'll learn about interesting stocks and how to value them. What's interesting about Adobe is that more than 90% of the world's creative professionals use its software. That's incredible. This is Andrew Stotz of the Valuation Masterclass. Let's get started. Remember, this information is for learning purposes only. This is not investment advice or a recommendation. So, Adobe is a leader in graphic design software. The revenue by segment breaks down, well, they provide various professional software products like Photoshop, Illustrator, and Dreamweaver. They are a subscription model. In fact, I remember a few years ago when they switched to subscription model, it was kind of gutsy, but now I have a subscription that I'm paying on. And 8% is coming from product services and others. So really, it's all about subscription. So really, their switch to the subscription model went well. 50% of its revenue is coming from the US, and then the rest is Europe, Middle East, and Africa, and Asia Pacific. I'm kind of surprised to see that so low in Asia Pacific, but in fact, it is. Now, let's look at the share price for a bit. A series of downward revisions led to a sharp price collapse. So in December of 2021, Adobe revised down its sales forecast for 2022. And the management admitted that it expects a slowing spending environment for 2022. The forecast was 1.5% less than analysts' expectations. Now, although the downward revision appears small, the share price plummeted by more than 10% the day following the announcement. Now, before I move on, I just would highlight something that I find fascinating. I was an analyst all my career in Thailand, in Asia. It always kind of amazed me about the analysts in America, how they're so close, like just 1.5% difference from the management. And I just saw, how are the analysts in the West so accurate? Whereas here in Asia, we may be 10 or 20% off. And here we keep hearing that the companies in America are missing their earnings by a penny. It just seemed like I couldn't really figure it out. Well, eventually I figured it out. And that is that in Asia, what's happening is that analysts aren't getting a lot of great guidance from the companies. But in the US, what's happening is companies are feeding them a lot of information. And from that information, they can then follow what the company says. In fact, most analysts do just that. In addition, when the analyst, when the fund manager, when the company is putting out a forecast or some sort of revision, what's happening is that the analysts are following them. And then when there's a change made, the analyst just makes a small change. So in fact, the analyst isn't really doing as much as they would if they didn't get any guidance from the company. The second thing is that when you're forecasting 12 months out as an analyst, there's no way you're going to be 1 cent off. What's happening is that the analysts are getting the first quarter result, they're getting more information, and then all of a sudden it seems like maybe their forecasting time horizon is very small. It could be a quarter, it could be a month. And so therefore, it's not like they're doing 12-month forecasts and they're off by a penny. It just can't be. So it's a little bit of a manipulation or a little bit of a game there that's going on. I just thought I would explain that because that's something that I find fascinating. And part of what I did when I did my dissertation at university for my PhD was look at the accuracy of analysts. And what I saw is that analysts around the world are overly optimistic in their forecast by about 20% or so. And that told me that, yeah, the reason why they're saying that they missed by a cent is because they may only be estimating for 1 month or even sometimes 1 week ahead. So continuing on, let's just continue on where I was. We can see that in March 2022, Adobe released its forecast for second quarter 22. And so now they're updating it. And again, Adobe expected weaker revenue, falling short of analyst forecast by 1.3%. Adobe mentioned the growing competition and the halt in sales to Russia and Belarus as the main reasons for slightly weaker performance. This earnings announcement was not great news for the investors as well. While Adobe delivered actually a strong second quarter, the company revised down its full year forecast by another 1%. So overall, Adobe's share price has collapsed close to 50% since its highest point in November of 2021. Now, actually, when you look at the business of Adobe, it's a pretty robust business. I have to admit, it's a very impressive business. And now we have a share price that's down almost 50%. That's also interesting. So, but remember that tech stocks had a bad start in 2022. It's not just Adobe that's struggling. Basically, tech stocks underperform the already weak S&P 500. Here you can see in this I've got a chart that I'm looking at that shows Netflix was down 69%, Meta 50%, Amazon, this is year to date, down 33, Adobe 33, Apple and Alphabet both down 22, and the S&P was down 20. Somebody was asking me last night on a video call that I was doing, do I think that value is outperforming growth now? Well, yeah, the statistics show that that's happening, but really it's kind of tech underperforming and value starting to see some performance. So is it time for value stocks to start outperforming again? Well, that's a report that I did a while ago called Is Value Going to Start Outperforming Growth? That's a look at the research that we did inside that report. But basically, you can scan this QR code and watch the full video on YouTube for free. And I'll try to put a link in this video also. Now, Adobe is a cash machine. Their business is not capital intensive. Its operation is not dependent on huge amounts of fixed assets or intangibles. Given the low CapEx requirement, Adobe can undertake a massive share repurchase program. So I'm just have a chart here showing the share buybacks that the company's been doing. In particular, they ramped them up from about $1 billion per year to $2 billion from 2017 to 2018. And then it went up, and now in 2021, it was close to $4 billion. Now, CapEx is tiny. CapEx is very, very tiny compared to the amount of share buyback. Now, some people, let's talk about share buybacks for just a second. And I just wanted to mention about share buybacks. I know there's some people that take share buybacks negatively. For me, I see share buybacks as neutral. It's just another tool. If a company has excess cash, it can either pay it out as dividends, where all shareholders have to receive that dividend, or it can pay it out as a share buyback, where only the shareholders who decided they want to sell their shares and they get that cash back. Basically, they get the share back. The point is that with the idea of a share back gives more flexibility so that the existing shareholders, if they don't want to receive a dividend, they don't have to. The other thing about share buybacks is that they're happening when companies have excess cash. So the question that you have to ask is the company borrowing money to have a lot of cash to then pay it out as a share buyback? If it's doing that, it could be risky for the company by taking on more debt, or they could be restructuring their balance sheet to say, we used to have a low amount of debt and now we want to have a higher amount of debt. And therefore, we're paying out this capital as share buybacks. So the only other thing about share buybacks is it tells you that the company is not having a lot of internal investment opportunities. If Adobe could reinvest the cash that it's generating at higher and higher returns, well, then they should be keeping that money in the company. But it tells you here that they don't have those types of opportunities. And you're going to see why in a second, because the company's profitability is just out of control. Let me just take a moment and say hi to everybody out there. I know Hillary's there. Apichakrit is there, and Abioye. Daniel, good to see you. So I'm going to continue on. And basically, the company uses buybacks as an alternative to paying out dividends. In fact, you can't really value this company using the dividend discount model. You'll see in a moment because it doesn't pay out dividends. So how does consensus look at Adobe? Well, most analysts are bullish, issuing a buy or a strong buy recommendation. But over recent months, analysts have been consistently revising down their target price. This is the hardest thing for analysts when the share price starts to fall on a good company. But the current price target implies an upside of 35%. The point that I would make here is that as an analyst, if you have a buy recommendation and the share price starts falling, what do? Well, what happens is that analysts revise down their target prices. And that's why some fund managers say, I don't care about target prices. I want to understand more about the business of the company. But I guess the question that we want to think about is, what is the value of this business? As the share price continues to fall, should we be considering buying it? But before I show you my value model, which we're going to go into, if you want to learn how to value companies like this, just check out the 6-week online valuation masterclass boot camp. You'd learn practical valuation skills by valuing actual companies. You'll access my tools, tips, and tricks for valuation. You'll join a group of inspiring financial professionals, and you'll get a job through my network of financial industry leaders. Just check when you have time to join the boot camp. The next one is scheduled for July 25th. We're getting excited. It's only a week and a half away, basically, almost 2 weeks. Group number 6 will come in October, and number 7 in January. So if you want to join the boot camp, you can join for just $697 by scanning this QR code, or just go to valuationmasterclass.com/bootcamp, or go to the link down below in the description. So let's take a look at my value model for Adobe. I'm going to switch over to the value model. 1 second. All right. So here we have Adobe. And what we can see is that the revenue of the company was 11 billion. And I'm just looking at this line 14. Whoops. That caused a problem. Hold on. Don't know why Excel's doing that these days, but it jumps around. Okay, here we are. I'm going to get back to where we were. It's not very friendly. Okay. So basically what you can see is that my forecast for revenue in the year 2022 is 17,916, going up to 19,833, and all the way up to 29, almost $30 billion. So we're almost doubling revenue between 2021 and 2026. That's a pretty big increase. What's interesting about this company, Adobe, is just look at how small the cost of goods sold are. It's a tiny item. So that means that the gross profit margin here, which I'm going to highlight that row, hopefully I can highlight it. The gross profit margin is 87% as of 2021. What business wouldn't you want to own that has a gross profit margin of 87%? So I'm going to assume that it's going to stay high like that. You could say that it's going to come down, but that is my forecast at this point. So it's pretty aggressive on the forecast. You can see that the profit is growing pretty strongly. But let's go down to the balance sheet and take a look at the balance sheet. The other thing that's interesting about the company, and I'm going to just go up to the current assets, is that, of course, being a software company, there's no inventory. Well, so they don't have inventory, and being a subscription service, it's not like in software they don't have a lot of accounts receivable, and that's fascinating. In fact, that's the big thing that changed over time when they went to a full subscription model. the accounts receivable were as much as 60 days for accounts receivable. That went down to 50, and then 40 roughly is where they're at now. So the only current asset of any significance, basically, the only significance here is we can see that there's cash on the balance sheet, a lot of cash. So next, let's take a look at the goodwill. This is another big item in the financial statement here. We look at the total goodwill. It's about half of the total value of the assets of the company. Now, with goodwill, what's interesting about that, from my perspective, is that that just tells us that the company is buying other companies, and they're paying a premium for those, and that premium to their fair value for those companies, that premium is being booked as goodwill. All right, so let's just play around a little bit and see what the impact would be on the valuation. Now, if you look at the chart to the right in the model, you can see that the free cash flow to the firm value is about 336. Free cash flow to equity is about 322, because why? There's pretty much no debt. And as a result, free cash flow to the firm and free cash flow to equity are the same. Also, you'll notice that on the chart on the right here, that chart shows that the dividend discount model doesn't produce any result because they're not paying dividends. They're doing share buybacks to distribute funds. So now what I want to do is flip to the next thing, which is, let's just look at our discount rates and see where we're at with that. So I'm just flipping through the model now, and I'm going to go into the discount rate area. So the first question is, what should be the risk-free rate? Well, I'm using 2.5. I think that's reasonable. The market equity risk premium, about 7, which gives me a market return of about 9.5. And the company's beta is about 1. So I would say that those are reasonable assumptions for the company there. Now let's continue on and look at the other assumptions. And that is some of the things related to the return on invested capital. The return on invested capital of this company is 44%. That's fantastic. ROE is also very high. And what I'm going to assume, it's going to go from 44.8 down to 33, which is still a 280% premium to the weighted average cost of capital of 8.8. Now, next, I want to look at the terminal value and see how does that affect the company's value. So over on the right-hand side, we can see that the free cash flow of the firm is 336. If we change our terminal value to 4%, what does that cause? That's going to cause the value to go up to 373. What if we change that terminal value down to 2% as an example? Then it's going to come down to 310. The point being is that the valuation that we come up with is pretty close to where the current price is. So maybe you could say from this that the company was previously overvalued and now it's gotten down to fair value. All right, so let's now go back to the presentation. And I just want to say to you, and I'm going to just go back 1 second. This analysis of Adobe basically shows me that it's a highly profitable company with strong growth. If we figure that into our forecast, good growth, that the profitability, gross margin, net margin stays strong, and we play around a little bit with the terminal value, we can see that at the share price now that has come down by almost 50%, it's at about fair value. I would say that from my perspective, it looks interesting now. If you bought it 6 months ago, of course, you're going to be suffering. If you have any questions about it, feel free to ask them now or put a question in the comments, and I'll do my best to answer those questions. And that is this valuation masterclass case study on Adobe. Have a great